this is Dr. Janice Seda. I'm the instructor for this course on grade 12 accounting. It's beautiful, sunny, and hot. Subang Jaya. That's the Canadian program at Taylor's College, and welcome to Malaysia. In this fourth video on financial ratios, we're looking at the profitability ratios. Now, some of you are probably saying, why are we doing this? Well, it's because we have this ISU, which is due on the 12th of November. So we have about 4 months. And so there's a report with presentations that you're doing starting the following Monday. And these are all the different parts, the different components of your ISU. We looked at, we chose a company, you found their annual report, and you downloaded the financial, well, the whole thing, especially the financial statements. What we're doing now is we're going to the analysis of the financial statements of the annual report. I hope you've printed them out, because once you've printed them out and you're able to work with it with pencil and pen and highlighters, it really gets you through a lot of things in the ISU. So I highly recommend it, and bring those printed statements to class. We did one video so far in financial statements that had to do with a horizontal analysis. And after that was vertical analysis, and then we began the financial ratio analysis of the company. And let's take a look at where we left off. As I said, here we are. We did cash conversion. We did one video combining, I think, current liabilities and being able to pay long-term debt. Now here we are at profitability. Now, profitability, let me see if I can find it. It's slide, I think, number 40. Yes, it's number 43. There's only 3 ratios here. Return on your sales, assets, and return on equity. What does return mean? Well, return means basically your profit or your loss on your investment. So that's what return means in that sense. Let's take a look at the first one, which is the return on sales. Return on sales, you want this to be a big number. The bigger, the better, because it is your net income divided by your net sales. Let's think of this rationally. What is net income? Net income is your revenue minus your expenses to get the net income, which is your profit. Of course, if your expenses are they exceed your revenue, then you have a net loss. And so you're looking at the profit over your sales. Now let's take a look at, because I like how we've been doing it. We've been using Apple. I've been using Apple because I've been able to get their annual report, and this is their annual report for 2014, and where we are now. Let's see. Well, we've got their net sales up here, 170,910. Now this is expressed in millions, so it's, I guess, 170 billion. And then where is it? Yes, their net income is right here, 37,037. Now let's take those numbers and let's plug it into a spreadsheet. So let's see if I can find the spreadsheet. Let me just pause this recording and get that spreadsheet. And here's the spreadsheet. So I've taken Apple, their net income. As you can see, it's right here. And over here is your net sales. So let me just plug in those numbers. So this, where is it? Your net income divided by net sales. And it's 22%, which is pretty good. What does this, okay, so here it is. It's bigger the better. When we plugged in the numbers for Apple, you get 22%. Well, Apple has this strategy of being a premier product. And their iPhones and iPads, it's more expensive than anybody else. More expensive than Samsung, Galaxy Tab. It's more expensive than the Sony Xperia. Everything in Apple is more expensive than anything else. A MacBook is more expensive than something that runs exclusively on Windows, your PC laptop. And so, because their revenue, their sales, like they bring in more than, let's say, if they sold the same things but they priced it like Samsung, you could see their net income would not be as big as large. So that's why Apple, what you're seeing, the 22%, it's as for a premium product, they seem to be on the right track because it's a pretty big number. Let's now look at another figure. And let's take a look at total assets. So we've got return on the sales. Now, return on the assets. Notice that instead of net sales, because this is return on sales, return on assets is net income divided by the average total assets. Now, where do we find that for Apple? Apple is, here we are. So remember we've got our net income. There's the figure for net income. And where do we find our figure for the assets? Assets, here we are. So we look at the balance sheet and assets, there they are. And here are the assets for 2012 and the figure for 2013. So you take the average of these two, and that's going to be your denominator. Let me go back here, and so I plugged in the numbers, net income for Apple, and then the total average assets. Let me just see where they are. So I'm just going to try to figure out. Now here's that spreadsheet, and there we are. So the return of assets, as you can see, I plugged in the numbers. So you've got here C32, which is your net income, and divided by the average of the net assets. And so, it's a percentage, so I'm just going to make it a percentage, and it's 19% is your return on assets for Apple. Now let's go back to my PowerPoint. Oh, what this means, I mean, this is not in your textbook, but it's probably under more of a business management strategy course, which I've taught several times. What you want to look at is these assets. How do these assets contribute to your net income? Well, if you've got total net assets which are large, then of course, okay, so if bigger is better, but then you've got a denominator which is pretty large, then this figure, like if it's very large, then you know that the number you get will be small compared to a company where the average total assets is smaller, right? So here's what I'm saying. In the past, businesses, they love to own their headquarters. This is headquarters of Tiffany or a major bank, etc. And so that was a bragging point. But these days, you're finding not a lot of businesses own their headquarters. Because you own the headquarters, it's an asset. And that increases this. However, what a lot of companies do is they rent their office space. And therefore, you remember, when you rent is the cost of being in that office space is rent. That's an expense. What does rent do? Rent is an expense, and you deduct those expenses from your revenue, and therefore your net income. Okay, so your net income, therefore, is smaller. When you have smaller net income, you pay less in taxes. So there's many benefits for a company to not own their headquarters or have too much real estate. You reduce this, you increase your expenses, which reduces this, which reduces your taxes payable. What you often see is one company, as is the umbrella company, they will own maybe a large share, or maybe own outright, a property management company, which happens to own office buildings. So then this office building company will lease space to the headquarters. So if they've spun it off as a separate company, then that both companies sort of benefit. Now, as I say, this is a higher strategic level thing, but one of the benefits is accounting is the language of business, and you can understand. I mean, if you want to reduce your net income in order to reduce your taxes, it's not a bad way to manage money. Okay, let me just go back and let's take a look at Apple. This is something I want you to take a look at because I find it a bit hilarious. Page 51. Where is page 51? Okay, here it is. Page 51, and this is Apple's 2014 annual report. And I've asked you to say, look at Apple's assets and short-term and long-term marketable securities, and do you know what this means? Well, let's see what it is that we're looking at before we figure out what it means. Okay, here is Apple. Apple is, let me see if I can draw this down. Okay, let me look at this up there. Right. So here's Apple, and they are now, let's see, I don't like that. Let's see, okay, there it is. It's much better. So here's Apple. Apple, I've said, please look at their cash equivalents. Okay, I prefer it this way. See if we can just shift it over. So their current assets is 14, and their short-term marketable securities is 26. So let's say it's 40. All right, so it's like, okay, so it's 40. Now remember, these are very liquid. Cash and cash equivalents, marketable securities. You can turn it into cash maybe 3 or 4 business days, I suppose. Short-term and short-term usually less than a year, and then the long-term marketable securities for Apple. Let's see if I can. There we are. Long-term marketable securities for Apple is 106. So 106 plus 26 plus 14. So that's 146. So 146. This means Apple. This is basically, if you look at, this is cash, basically. It takes a while to get it in terms of cash, but it's basically cash. So Apple, their assets is 146 of very highly liquid assets. So 140 out of 207, I think I saw a figure of 67%. So it's definitely more than 50%. So 60%, more than 60% of Apple assets is cash. They don't have a lot of inventory. They don't have a lot of inventory. I mean, even their cash receivables is pretty low. So as I say, 67% of Apple's assets is cash. Let's look at the equivalent for Samsung. Actually, let's look at it. Now, that was the annual report. Let's look at the annual report for Apple. There's a quarter Q2 report. So Apple. So here we are. Cash equivalents, 14. Remember, it was 14, now it's 15. Marketable securities, it's 19 right now. So, let's see, it's 35. Their long-term marketable securities, 169. Just doing the rough math. That's 207, right? 207 out of 273. Apple has this much money. I mean, more than 60% of the assets of Apple is basically cash. Cash. That's $270 billion in cash. Apple's inventories is it's barely 1%. Their accounts receivable is it's about 5%, is it? It's just not a lot at all. Let me just check. And compare this to Samsung, 61, and over here investments 14. So 75 out of 231. That's about 33%. My goodness, what a difference.